Hi, welcome to Let's Talk Bonds, the fortnightly podcast from INR Bonds. I am Arjun Patsati. And in this podcast, I'm going to talk to you about the repercussions of the union budget on the taxation part of the MLD market, MLDs, and what could be the potential negatives and what are the opportunities as well. So basically, MLDs or market linked debentures were a very strong wealth management product where wealth managers took these bonds to their clients on two factors. One is that they offered a market linked kind of a return. So if it was they were equities and they were also fixed income in terms of linkages. And this market found a lot of favor with investors to a very large extent because of the fact that it did offer uh, a uh, uh, capital tax gains tax advantage for those who had consulted their auditors and who had approved that MLDs are good investment and capital tax friendly. So basically, market linked debentures, because of its structure, whether it was linked to a Nifty or a 10-year GSEC, offered a 1 year plus kind of an indexation benefit on capital gains tax. So hence, investors for any other debt security, the tax was or interest, the tax was fully at the slab rates. And for capital gains, it was 3 year plus kind of a holding period. So hence MLDs were pretty much attractive. And because of this, and because of the fact that um, the higher tax bracket investors, especially the ultra high net worth, where tax bracket is 40% plus, found these bonds very attractive. And this market grew and grew and grew. And as of last year, the estimated size of the market was well over 50,000 crores. And some said it's almost rupees 70,000 crores. No documented um, uh, records. Maybe it's just around these levels. Um, but definitely a very large market. Now, this market, given this market was such a high growth market, a lot of issuers, especially NBFCs, had accessed this market to raise funds for their businesses. And they found that raising funds through MLDs was cheaper than trying to raise it through bonds, largely because of the capital gains tax that it offered investors. And also many lower rated issuers were also able to place out MLDs, largely because of the fact that the market was growing and there was a big amount of demand for all kinds of MLDs. So those were risk averse, bought into high grade bonds, and those were not pretty much willing to take more risk, bought into lower rated bonds. Now, in this union budget 23-24, the tax laws changed, and the laws said that any income from MLDs became short-term capital gains. Now, since it's a debt security, it becomes a fixed income kind of a short-term capital gains, which is at the slab rate, unlike equities, which is about 15%. Hence, this law suddenly has changed the dynamics of this market, and further, it's completely killed this market. So suddenly, when issuers had a market to go to raise funds, and ultra high net worth investors or even high net worth investors had a product that were offering some superior tax benefits, which they were not getting elsewhere. Then now, so the issuers will have found that the market is not closed now, and the ultra high net worth investors have are stuck with bonds that they cannot sell, and the second is that um, they don't have a product at present to actually compensate for this MLD lack of MLDs. Now, the earlier, the go-to bonds tax for tax conscious investors were tax-free bonds because they offered tax-free returns. But tax-free bonds also issuances have been stopped for a while, and whatever is available has been issued previously, and hence because of that, the yields are very low. So even long-term tax-free bonds are trading at around 510, 520 kind of levels, which is again very low levels of yields, especially for long-term risk. Hence, in this sense, definitely happening in the market at this point of time is that the corporate bond market, there is a huge amount of selling pressure. One is for MLDs itself, and the second is that there is a huge amount of need for liquidity by issuers who cannot access this market. So clearly, yields are going to go up for lower rated issuers, NBFCs especially, and that could impact a lot of other things as well. And the most important is that with all the other issues in the market, including rising government bond yields, RBI came out with almost a hawkish policy, and globally, central banks are raising rates. All this put together is now causing a bit of a confusion in yields, and that are trending up only. So yields can trend up much faster from here. Or this is the negative part of it. On the opportunity side of that, now it's a question of what is the best solution to offer for investors who are tax conscious and who one is that clearly 3-year plus kind of products like mutual fund products, etc., are tax efficient, but 3-year plus over a longer period of time, the returns have been very violent. And in the last 3 years, returns have been very poor. So investors have not really gained anything. So you never know what the returns you're getting. So is there any product that can help investors to try to both get the shorter duration products along with the tax efficiency? Now that's something the structurers can think about. On the other side of that market is the fact that yeah, the what should investors do now, given that invest or financial advisors uh, tell their investor clients or advise their clients on investments in fixed income. Best is to stick to, as INR bonds have always been maintaining for a while now. Stick to short tenor bonds. Check the risk profile. If you're risk averse, best is PSU bonds or short tenor PSU bonds. You can even get 3 months to 1 year, 2 years, 3 years maximum, with 3 years plus also. But risk averse can invest in PSU bonds that are even coming at good levels. Low investors willing to take slightly better risk and also want higher yields can look at other short tenor bonds that are available in the market, which subscribe to their risk adjusted returns profile, and they can invest in such bonds. But again, it's a very clearly a rollover market and not a market for investing for long-term fixed income. So takeaways from this podcast. One is that disruptions in the bond market, a very large part of the market, a large 50,000 crore rupees, 50,000 crores plus market has vanished. Issuers are going to face a tough time, so yields are going to go up for lower rated issuers or other issuers who don't have enough liquidity in the market. And investors will have to search for opportunities, but right now many of them are stuck with MLDs. Till they sell it off, they may not have the appetite. And the third is that best is to stay short, stay safe, find PSU bonds or slightly a better risk adjusted return kind of bonds with short-term maturities. Thank you very much for listening in. For financial advisors, INR Bonds Partner Portal is the best place for you to invest in. through for your clients. Log into partner portal, see all the bonds that we have curated, and with our own score for your to get the best risk adjusted returns for your clients and the easiest of investment processes. And download our app, we can invest by our bonds for the best curated list of bonds on offer. Again, to get the best risk adjusted returns on bonds with our own proprietary risk score and all the information and transparency that you require, and the best of in-app investment processes. And finishing off with highlighting the risk of bonds, which is bonds carry price risk. Prices go up and down, so there is capital loss involved. Carry default risk, corporate bonds. So fundamentally weak issuers can default, or even strong issuers, so weaken in their business profile can default. And liquidity risk, that is investors may not be able to sell the bond as quickly as they want to, or may not be able to sell it on at a price they want to. So without consult a financial advisor for investing in bonds, or invest with knowledge. And INR bonds provides you all the tools to get knowledge from for investments in bonds. Thank you very much for listening in, and follow us on our podcast channels.